Well, good afternoon, everybody, and a very warm welcome to all our attendees today to our webinar, which is brought to you by leading auctioneers Acuitus, hosted by Knight Frank, and supported by IPSX, the new stock exchange for real estate. My name is Kevin Marriott, and it is my pleasure to host you today and to try to keep the panel in order wherever possible and try to run us to time. I do apologise for the short delay in getting us going this afternoon. We were experiencing a few technical difficulties, but we're with you and we're raring to go. Just a couple of housekeeping points before we get started. First of all, we've got quite a number of attendees on the webinar today, so we're not able to take questions through audio contributions, but we are able to take them through text. And you can find the text box on the panel of your screen. So please do submit any thoughts, contributions, or comments that you would like to make as we're going along, and I will do my level best to get to you and to try to find an answer to your question. So without further ado, let's meet our panel today, and I'm delighted, first of all, to welcome our first speaker, which is Chairman and Auctioneer Richard Alterac from Acuitus. Good afternoon, Richard.
Good afternoon, Kevin. And good afternoon, everybody.
Thank you.
That's here. Yes, Kevin.
Thank you. Thank you very much, Richard. And our second speaker today is Jeremy Than, who's Head of Bank Lending and Valuation Advisory at Knight Frank, who is also our virtual host this afternoon. And a very special welcome to you, Jeremy, and a big thank you to you and the team at Knight Frank for hosting our webinar this afternoon. Hi, Jeremy.
Hi, good afternoon, everybody. Hope you're all well.
And thank you. And our last speaker today is Roger Clark, who is Managing Director and Head of Capital Markets at IPSX, the new stock exchange for real estate. Hi, Roger.
Hi, Kevin, and good afternoon, everyone.
Very good. So it's great to be with you all, and of course today is a great time for us to be reflecting on the topic of where we find ourselves right now. And of course, from an investment point of view, is really now the right time to be re-entering the market. The challenge really is now for all investors to be considering what the options are. And of course, the valuation industry is critical in the way forward, and commercial property auctions too play an important role in bringing much needed liquidity to the private investor market. In the session today, we're going to be reflecting on some of the lessons that we can learn from the previous economic downturns and subsequent market recoveries. We're going to try to discuss the challenges that are facing the valuation process and, of course, what this means in terms of bringing transparency to asset values and, of course, therefore, to investors. The panel will consider also whether specific real estate sectors and indeed locations might be more attractive to investors than others as we emerge in a post-pandemic world. But before we make a start, what I'd like to do is let's ask you, the audience, your thoughts on where we find ourselves today, and then let's return to the same question at the end of the session to see perhaps if your views have changed. So let's bring up our question to kick off this afternoon's webinar. And I'm hoping very much that this is appearing on your screen. And the question is, first of all, are you planning on investing in commercial property in the next 3 months? And it's a simple question for you. And what we'd like you to do is to either vote yes or to vote no, or if you're at all not sure, just click on undecided. So away you go. If we could ask you to make your vote, please. Okay, so let's get the results of that vote. So well, there we go. A 44.3% vote for yes, a 28.9% vote for no, and an undecided of 26.8%. So quite an interesting split there. So let's move on. And before I welcome Richard Autorak to open proceedings, let's remind ourselves that in some respects, we've been here before with Black Friday, with Black Wednesday, and the bursting of the dot-com bubble and the 2008 financial crisis. However, while the causes of each of these were very different, and without doubt, this is the most serious, how investors have reacted across those particular points in time have perhaps been broadly the same as we have seen before. So let's find out what Richard has to say, chairman and auctioneer at Acuitus, who of course has got many years of experience and I'm sure can help us with some of our understanding about these trends and what this means from an auctioneer's perspective. So I'm delighted to welcome Richard. Richard, the floor is yours.
Thank you very much, Kevin, and good afternoon, ladies and gentlemen. Delighted that you're joining us here today. I'm going to cover two parts from this session, very simply. What lessons we can learn from the past, the previous cycles that there have been in the auction market over the last 30 years. And the other item I'm going to cover is this the right time to enter the market if you're an investor? So greater minds than mine have posed the question about what's going to happen next, greater minds than mine around the world. And I'm sure many of you on the webinar today have got a greater mind than me as well. So I can probably add very little to the general discussion about COVID and what happens now. But what I can offer is my knowledge of the auction market. And that knowledge goes back many years indeed. And also I can offer you the benefit of having been consistently in the market since lockdown happened 3 months ago. And indeed, Acuitus had its last auction only a few days ago. So we've got live up-to-date information and also a huge knowledge of what does happen in the auction market, which is very much a private investor market. It's a very human marketplace. And there are countless investors making individual decisions all the time. While the assets perhaps are not considered to be institutional quality, they are of sufficient investment grade for high net worth investors to invest in the long term, as well as for investors to put them in their SIPs. So the quality, the investment grade quality is there. They may not be suitable for the institutions, probably in many cases by the fact that they're relatively small lot sizes now. In fact, many of the properties we have sold over the years have previously been owned by institutions. So from the point of view of the quality of the assets, they're very much high quality. So I think that the observations we can make about the commercial property market do have a wider application to the property market. Generally, as I said, the lot sizes may be smaller than the institution's lot sizes, but they are perfect for the private investor and the private property company. And the majority of our clients are sophisticated, they are knowledgeable, and I think that what they bring to the whole market is their entrepreneurial approach to property ownership and trading. Many use the auction market as a barometer of the overall market, as well as a leading indicator. So it has a bigger role to play. So what lessons can be learned from previous cycles? I mean, we talk about economic and financial cycle, but there's also a private investor cycle. And this is the private investor cycle. And whilst cycles, recessions, call them what you will, have different causes, how the human beings react to them has some similarity between the cycles. And it depends. If you look at the cycle here, at the top you could call it the bull market, at the bottom the bear market. And how you react through that cycle very much depends upon whether you're the person that's been left holding the bag when the music stops. I apologize for the mixed metaphor there. Or whether you are the the investor who has been lucky enough to have cash available to invest. But as you go through the cycle, you can see that there are times of the cycle where activity is very much reduced. And there are other parts of the cycle where sales start to come through or transactions start to take place. And you can see very much that in the, let's call it the top is, let's call it north, the south east quadrant is when you find that sales start to pick up. And of course, also in the northwest quadrant as well. I hope that is clear. The low point in activity, what I wanted to point out to you is the bottom, is that no one ever can call the bottom of the market. So if we look at the time today, I mean, is it the bottom of the market? Well, frankly, no one can call the bottom of the market. It's only done by hindsight. But you can see as you move away from the bottom of the market up to a level where people start to believe that it actually has gone past the bottom of the market, then then investors start to believe that property is a one-way bet. And of course, that moves into a bull cycle, which eventually goes into a bear cycle. If we look at this in graph form, the data goes back to 1985, and this particular chart depicts the level of activity between 1986 and 1996. And you can see the peak in 1988, the dramatic fall off, the nadir, which we see in 1992, and the W-shaped recovery which took place starting in 1992-93, and then eventually the recovery became more sustained as we went through 97. And then if we go to the next one, which is the second cycle, we can see this starts again in 2002, and I've taken it to 2020, but for all intents and purposes, that cycle ended in 2016. And what's interesting here is you can also observe the steepness of the decline after 2007, 8, and the W recovery after that. So I think there's some similarities there. In the next two slides, I'm going to focus on some of the fundamental issues around the behaviours during the second cycle. Let us believe the first cycle is represented by the second cycle. So this is the second cycle, 2003 to 2008. I think what's key here is that GDP starts to rise in the 2000s after the dot-com crash, the dot-com bubble. GDP rises and bank lending kicks in at that stage. Activity levels rise, prices rise, and as you can see, the risk premia that's applied to real estate is reduced. The gap between prime and secondary is reduced, and people, investors, look at the properties as if there's a one-way bet and there's yield compression, which led to irrational exuberance, and we know then led to the global financial crisis. In this one here, this is actually looking at the other side of the global financial crisis. This looks at the period 2010 to 2017. This is on the other side of it. And we can see that immediately afterwards there were few sellers and few buyers. And the loan defaults started to take place. But I would also like to point out from the private investor's perspective that we really only saw them return to the market when debt became available again. That's probably about 3 years after the institutions got back into the market. The institutions very much were liquid, and that liquidity was increased by the inflows of global capital at the same time, which is well documented, as you know. So the private investors were later into the market. They were responding more to the fundamentals of UK PLC. And what happened then, as I said, as you can see this, is then bank lending starts, assets that were in loan books started to come to the market, and trading volumes increased. And they increased until 2017. The political uncertainty from 2017 is still with us today. And as the year unfolds, that uncertainty, as we get towards the 31st December, will no doubt increase. So that's there. The retail crisis, 65%, about 2/3 of assets that are bought by investors are retail assets. And the malaise in the retail market has been very well documented. This is the high street market. So we still have those issues. And we also have an issue of the fact that sellers haven't been wanting to sell, and there has been a paucity of stock for buyers, investors to invest in. The sellers have, or buyers, shall I say, have outnumbered sellers for quite a number of quarters since 2017. But above all this, of course, is COVID. That overlays the whole thing. And the questions we have to ask ourselves is, will sellers want to sell? Well, the first reaction will be, how much will I lose? And then they'll say, well, actually, must I sell now? And that may be a factor of pressure from loan services, or it may be they need to repatriate money into their core businesses to sustain them through this very difficult patch. And I think that from an owner's perspective, they need to be looking at is the rent being paid? Will it be paid? Will the rent be reduced, etc., etc.? So they have some big decisions to make. From the buyer's perspective, of course, if you're cash rich, you're sitting pretty well at the moment. You need to make sure that you pick your occupiers well. There'll be winners and losers, and as we all know, and that's again been well documented. But property still has that attractive income yield, very attractive compared with government bonds at the moment. But of course, income yield is only as good as for as long as the tenant can pay the rent. So it all comes back to that. Availability of debt. We know that the banks have been very busy dealing with the government loan scheme. It's only recently they've had the resources to go back into lending again. But there is also, from the buyer's perspective, definitely a lack of stock. Is this the right time to buy investments? Well, the answer is yes, but unfortunately, they won't necessarily be there to be bought. As I've said, buyers will be making decisions, sellers will be making decisions, or owners will be making decisions about whether they sell or not, and that may take some time to work through. At the end of the day, of course, it's the likes of you and me, the consumer, who will determine who will be the winners and losers in the retail space or in the service provision space, those winners will go on to become the tenants for the investments that people want to invest in. If we turn to our very recent auction, well, in fact, we actually haven't been out of the market for the last 3 months. We've been very much in the market, and the auction we had 2 weeks ago was just the last auction that we held. So we have been very much in the market. What you should invest in? Well, a good starting point when deciding what to invest in is the tenant paying the rent. If they are, what portion of the rent are they paying? Are they intending, if they're not paying the rent at the moment, to come back in and pay in the future? Is it a business that will survive post-COVID? That's very important indeed. And that leads me on to the sort of investments that are popular at the moment. There's the supermarkets, naturally, the local convenience stores, the pharmacies, the industrial units, indeed anything that's on a long lease where it's let to medical premises or a job centre, where the covenant is undoubted. Also, and this is important, anything that has proven residential alternative use is also popular with investments. So if you have a commercial property that can be converted or part converted to residential, particularly in London, the Greater London area, then it will be, and the South East, that will be very popular as well. For those assets, prices have not significantly changed. Almost all assets are saleable, clearly, but it's subject to price, and it's also subject to whether the owners actually want to sell. And as I said, I think at the moment there will be reluctance to sell, or there will certainly be a delay in making those decisions. Remember, our buyers are entrepreneurial and resourceful, and they can take a view on anything, but again, it's subject to price. Just to conclude, is this a good time to invest? Well, it may be, but it depends on the assets. It's not a one-way ticket. It depends on the type of asset. You've got to get the assets right. And I've given some example of those where where the assets are popular to investors. But as I said already, the key thing is, will investors want to sell at the moment? Don't forget, of course, that past cycles give a clue to what's happening in the future. This last slide looks at some of the issues that there have been, have past investor behaviour. Can that inform what's happening at the moment? And I think absolutely, yes, it can. I think it's down to the consumer to know what they'll be wanting to buy in the shops and what services they want to be provided as well. And there's inevitably going to be a long period of, shall I say, tussle between the sellers, between the buyers, between the funders, and also the occupiers. So there'll be a lot of this going on over the next months. It might take a lot longer, of course, to work out. Anyway, if you'd like to continue to follow our market, just to mention that our next auction is on Thursday, the 9th of July. Thank you very much.
Jeremy, of course, this is a big moment for valuation. It's been a difficult and must have been a very busy few weeks for you since lockdown started. I guess the big question that everybody out there is really asking themselves, and I hope that you'll be able to somehow or other begin to answer for us, is has COVID-19 really affected decision-making and investing in real estate assets? And I guess the second big question is, when now is the best time for asset owners to think about the property assets that they own? Jeremy, would you like to share with us your thoughts?
Yeah, thank you very much, Kevin. So what impact has COVID-19 had on decision making? Well, I mean, to set the scene, transactions were happening, were progressing on the run up to lockdown, but then lockdown came, and those transactions that were due to exchange or complete suddenly went on pause. So I think the interesting thing is, where are we now? And to look at general sentiment in the market, Knight Frank's research and agency teams undertake a weekly survey, which covers the leasing, capital markets, tenant rep, and flexible offices. Just focusing on the capital market sentiment, and this is our sentiment survey, so you have in front of you, just looking at the capital market sentiment, you will see that at the start of the survey, we witnessed very negative sentiment in the market. As we entered into these unprecedented times, we saw an increase in the deals aborted, sales withdrawn, and a decrease in deals that exchanged. But interestingly, we saw an increase in calls from international and UK investors. Scrolling along by a few weeks, come week 3 into lockdown, we saw more negativity emerge, with the exception from UK investor sentiment increasing. Reaching week 5, we see some stabilization in the markets, although at week 7, we see another increase in the deals aborted and sales withdrawn / put on hold. But then we see a following stabilization in sentiment. And then, as at last week, we see more stable sentiment in our market and some uptick in green from UK investors and deals reaching exchange. And I'm sure we're all hoping that that sentiment continues as we ease ourselves in and out of lockdown. Moving on, the next slide highlights the diverse investor base we find ourselves within the central London market. And as you can see, there's no one dominant buyer, and it'll be interesting to see how these statistics change over the next 2 quarters that we find ourselves in the market. But in general, we are seeing a flight to quality by investors, where they are looking for tenants who have strong balance sheets and perceived strong covenants and long leases. And what we are aware of a number of investors who are still waiting in the wings, who are waiting for that right time, and more interestingly, for those opportunities they think will come out during this period. Moving on, the next slide highlights our observations in the debt market. On the run up to lockdown, we had a liquid lending market, but as we went into lockdown, this changed, with the period uncertainty having a severe impact on the financial markets. Our own debt advisory team, headed by Lisa Attenborough, undertook a survey of lenders. And as can be seen on the slide, debt pricing increased from between 15 to 200 plus basis points pre-COVID levels. This making financing deals difficult with cost of funds, but also the uncertainty of deal execution. However, on a positive note, I would say that if we undertook this survey today, the chart would be very different, as we could see that margins have crept back down as debt markets stabilise, albeit I would say they still remain ahead of pre-COVID levels. As part of the lending survey, the participants were also asked what appetite they have for new business. The green bar that you can see up there represents the lenders that are open to new business for existing clients, whereas the hatch bar represents sentiment of new business to new clients. This is very different from what we would see in a pre-COVID landscape, as new business would have been very much available to new clients. Again, in my view, and from our discussions with lenders, if we undertook the survey today, sentiment to support existing clients would still be strong. But I would say with the caveat for new business, whether it be to existing clients or new clients, the focus would be on asset risk, strength of cash flow and covenant, the business plan, the sponsor, and their track record. Therefore, I'd say that if you are a buyer in today's market, cash is clearly God right now to execute your deal. And I think, will we move on to Roger, or is Richard back? Thank you.
Thank you, Jeremy. That's very, very helpful. And if you can perhaps put yourself back onto mute again for me, we can then bring you back in on the Q&A. So a really interesting and some very thoughtful points I thought you made there, particularly the sentiment index that Knight Frank have been working together on. So there's already some questions coming in from our audience around valuation, and we'll get Jeremy back to talk to us about those points. So let's now go to Roger Clark, our third speaker this afternoon, who is the Managing Director and Head of Capital Markets at IPSX. Roger, I'm sure you're going to tell us a lot about the new stock exchange that we've been working away on in our 2 markets. But could you also just tell us a little bit more about how you see this market being able to help investors?
Yeah, thank you, Kevin. So, as Kevin says, we have IPSX is a new stock exchange, and we have 2 markets, which I would like to just very, very briefly explain to you. IPSX is the only stock exchange like this in the world today. Regulated by what's known as investment, 7 of those, and they include the London Stock Exchange, the International Petroleum Exchange, London Metal Exchange. It's quite a rare company that we're in. We're also, importantly for real estate, are a recognised stock exchange as far as HMRC are concerned, and this means that stocks which list on our exchange are eligible to enter the REIT regime and have full tax transparency. As a recognised investment exchange, regulated by the FCA, it means that the shares traded on our exchanges are eligible to go into SIPs and ISAs. And of course, that's very important for the audience today. So the two markets, the first is called IPSX Prime, and this is a regulated stock market, just like you'll be familiar with the London Stock Exchange. It's open to all investors, including retail investors in every sense of that word. Companies that list on the exchange will own single pieces of real estate, or in certain circumstances, they can be portfolios of assets where the assets have a degree of commonality, where the assets are all the same. An example could be a portfolio of self-storage sites, or a portfolio of student accommodation or surgeries. The point is that you as the investors, if you understand one of those assets, you will understand all of them, as opposed to a balanced fund or a diversified REIT, where as the investor, really, you're leaving the allocation decisions to a fund manager or an executive management team. Like all companies that list on regulated exchanges, 25% of the shares at least need to be sold to the market. This exchange has an LTV limited to 40%. And the assets need to be stabilized income-producing assets. In other words, it's for core or core plus assets, very defensive, income-producing. Companies have to issue a prospectus, and that has to comply with all sorts of regulatory requirements, which means when you read this prospectus, you will know everything you need to know about the company and the asset it owns. And that is pre-approved by the FCA. And most importantly, companies that list on this exchange have a guaranteed degree of liquidity in the aftermarket. That guarantee is provided by a market maker system. Again, just like stocks that you're used to on the London Stock Exchange, you'll be able to phone up people like Peel Hunt or Pamela Gordon and get a firm two-way price at which you can either buy or sell shares all day long during market hours. Obviously, that contrasts quite importantly with some of the funds which are available to retail investors today, which are gated and which you cannot either get in or out of them. That will never happen to something which is listed on IPSX Prime. IPSX Wholesale, our second market, is a little bit different in that it is designed only for institutional or professional investors. This means it has some quite important differences. The first one is that there is no prescribed minimum free float. And this is interesting for issuers because it could allow people who actually don't really want to sell assets but would like to enter the REIT regime and get the benefits of full tax transparency to do so with much smaller free float. In some cases, it could be as little as 1%. Unlike with our prime market, the assets don't necessarily need to be income producing. So we could see development assets here. We could see refurbishments. We could see JV REITs. We could see a much broader spread of asset. And drawing the analogy with private equity funds, we will see much more similar risk profiles to value add or opportunistic or development funds. And the LTV can be higher. It could be as high as 80%. And again, from the issuer's point of view, the process is slightly different in that a prospectus does not need to be pre-approved. Something that's technically called an admission document for an investor by us as the exchange at IPSX, which means the process can be a great deal faster and cheaper for the issuer. So what's in it for the investor? That's what's really interesting for you today. And I think that there are 3 points that I would like to highlight, which are revolutionary and new. The first is that we're going to see access to new tangible asset-backed product. You know, of the UK commercial real estate market today, it's just under £1 trillion worth of investment-grade assets, and just over half of that is held by institutional fund managers or REITs or property companies. It follows that over £400 billion worth of assets are owned by owner-occupiers, and these assets have never been in the capital markets and are not investable by you. But some of them are really interesting. If those owner-occupiers see an exchange like ours as having more flexibility that allows them to release capital by bringing in investors alongside them, but retaining a degree of operational flexibility, there's up to 400 billion of assets that we've never seen before that could be investable. That's really, really exciting. Secondly, of course, I touched on the fact that it's a regulated stock market, and that means transparent market pricing. The companies will have to get valuations done in the usual way that are compliant with the Red Book. So Jeremy and his colleagues will still be producing formal valuations, and they'll be doing that every 6 months. But unlike with private unlisted property, you'll be able to get a pricing point every day. So as we know, the value of real estate rises and falls all the time, not just once every 6 months. And this daily pricing will allow investors to see it every day. And that's really interesting because it will attract investors into our asset class who today don't use it. And thirdly, as I say, we can't stress it enough, it's FCA regulated. It means there are regulatory protections for investors. There's a high quality stamp running through everything that we do. Now, I just want to finish by giving you a sense of what our market will actually look like for you as investors. And here we have some sample pages of how the trading platform will actually look. You'll come onto the IPSX platform and you'll see a landing page like this that will show the headline details of all of the assets which are listed and tradable. And if you want to pick one of those, let's go with Cobra Place, you can then go into it and get a little bit more information around the asset. All of the reports and news flow will be loaded here. And of course, here you'll get the pricing data at which you can trade. In other words, what we're doing here is we are bringing single pieces of real estate or portfolios with commonality to you as the potential investors, just like listed companies you're used to on the stock market. And all of this data, all of this accessibility, all of this transparency will be there for you. Kevin, I'm going to hand back to you then.
Lovely. Thank you very much indeed, Roger. That was really interesting, and I am sure we're going to be getting quite a number of questions from the audience about IPSX and the two markets of prime and wholesale, as you have outlined. I think it is particularly interesting from an investor's point of view, the opportunity that IPSX is going to bring, and particularly the ability to see the transparency of those assets as you were describing them. So I am sure there's going to be lots of thoughts about how does valuation work around those, how are we able to trade our shares in those entities and so on. So let's have a look at the questions that have been coming in. So Jeremy, I'm going to come to you first. Unsurprisingly, there's a lot of valuation questions and points being raised this afternoon. Let's start with this one, if I may, Jeremy. In the absence of valuations, what do you see that auctions can tell us about asset pricing? And are there enough pointers at this current moment in time to tell us how much prices might be changing?
Thanks, Kevin. I mean, it's a very interesting one. I mean, as I always say to Richard whenever we speak, the auction market is the most up-to-date market where you see things actually happen real time in the room, where you get but you see the willing buyers with the competitive tension and bidding. So we always look to the auction market as a barometer of what's going on in the economy. And buyer sentiment, and I think if Richard would he'd probably opine on how interesting the lots are and how much you see in terms of the bidding process. So that's that side of things. So it's very useful as a guide as we see it, and what's going on. In terms of us as valuers, right? Oh, sorry, go on.
No, absolutely. Please keep going.
Sorry, I was going to say in terms of the second part on what we are seeing as valuers at the moment, I think it was fair to say, as I mentioned it at the start, on the run up to the lockdown period, we were aware of a number of transactions that were due to exchange and due to complete on the run up to that week. They did happen without, as we understood it, any price chipping going on. And as we have been through this period of, I keep calling it lockdown, this period where we are all working from home, etc., there have been a number of transactions that have occurred, and it's been well publicised by the RICS that the material uncertainty clause has come out of certain sectors. So that shows that we have had, we've seen transactions in those markets, so that we feel happy that there's that certainty in the market. Thank you.
Very good. Okay, thank you, Jeremy, for picking that point up. I'm now going to come back to Roger. Roger, let's just, if I may, pick up a couple of points about some of the things that you were telling us in your points. I'm sure that there is going to be a lot of interest from those that are with us today about our new markets. From your point of view, are you getting a sense of where investor interest and dare I say it, investor demand might be lying right now? We've seen, haven't we, over the last sort of few weeks or so, quite a number of follow-on raises happening in the capital markets. Could you tell us a little bit about that, and perhaps your thoughts about where you see demand?
Yeah, and I think it comes back to this point of transparency. It's very interesting the way listed real estate, and obviously all of my comments are based in the context of listed markets. It's very interesting to see how it's behaved over the last 10 to 12 weeks. In that we had a period in March of sort of mass market hysteria, and everything moved in line, and there was almost a perfect correlation between the listed real estate on the London Stock Exchange and the wider equity market. Now, of course, that is not what you buy real estate for. It's slightly disastrous to get market tracking performance. But fairly quickly, we saw a little bit of rationality reappear, and particularly where companies, listed REITs, where their sources of income were easily identifiable and well understood. Sources of income could be assessed in terms of their strength. We saw prices rebound quite quickly. And there obviously have been some winners and losers. For example, a formerly very popular sector amongst listed real estate was university student accommodation. And now, of course, the demand for that, given how important overseas students were, is really quite uncertain. Meanwhile, we've seen properties like primary healthcare property, doctor surgeries. We've seen supermarkets, and we've seen the continuing demand for self-storage lead to, as you said, Kevin, some very strong fundraisers. Companies like Schroeder, Supermarket REIT, London Metric have raised money during lockdown well ahead of their published NAV figures. And in each case, those three transactions saw such demand from investors that the deal sizes were increased significantly. And in each case, the shares today are trading higher than they were placed at the time. So demand for asset-backed income is as strong as ever. It's just a question of being certain and clear about where that income comes from and how robust it is.
Big question here, Jeremy, for you about retail. And hardly surprising, given the seriousness of what we're seeing at the moment. Let me put this one to you. How significant are retail properties to the overall portfolio of an investor? And might this now begin to change as a result of what we're seeing happening right in front of our eyes today?
I mean, I think we all appreciate the retail landscape is continuing to change with the direction of travel from where it's been coming from to where it potentially go to is one that most investors feel that it's not something they want to be to have in their portfolios right now, with values declining, potential tenant defaults, and the fact that the retailers are struggling. Does it have a place in the portfolio? Yes, I think it does at the right price, and I think we, as an investor, you would be looking as best as you can in terms of the affordability of the rent which the tenants can pay, the strength of the tenant covenant, their trading, etc. I mean, I know in the recent webinar undertaken by my retail capital markets colleagues, some of the questions were asked whether or not we're moving towards a turnover-based rent, which was very much shunned in the early years when the tenants were trading superbly. But now, as they're going into the reverse, it looks like that's going to come into favour. So it's a rather interesting environment we find ourselves in, because I think if we look at, say, out of town retail, I think that presents great opportunities there at the right price, because you are able to social distance to a certain degree. The units are generally a large big box, and then coupled with that, if you're looking at alternative uses on the site, potentially for perhaps industrial, and as we see it for potentially residential. So, when we value out of town schemes, we also look at the alternative values as well and see what the viability of that could potentially be.
Okay, thanks, Jeremy. That's a wholesome answer. Roger, I'm going to come back to you now, if I may. There's a question here of how relevant is the data produced by a public stock exchange to informing valuers' opinion? And I am sure Jeremy's going to have a view on that too. So you told us a lot in your opening piece there, in your opening remarks, about how the exchange is going to operate. Could you expand perhaps a little bit more about this data point and how that might help the valuation piece?
Yeah, we've never had before at the asset level daily pricing. I think the idea that there is a marketplace in which people can agree to buy and sell shares in an asset on a daily basis must inform other users. And I know in my experience as a banker, we've often looked into potential M&A opportunities where listed real estate companies have been trading at very large discounts to NAV. And in actually then combing through the assets at the asset level and doing the kind of due diligence that working with professional advisors you can, you tend to find that usually that discount is not quite as big as it initially appeared. And what do I mean by that? It means that the NAV actually turned out to be quite overstated. I sometimes question whether some of these companies that are trading at large discounts to NAV really are, or is it actually a case that the pricing, the real-time pricing provided by the stock market is actually just way ahead of the trailing valuation? So that data, I think, should be relevant. And I know I'm not going to speak for Jeremy, he will say it in a moment, but I know that the RICS is beginning to take into account where bond yields are when thinking about how to value real estate. So why would you not take into account where share prices are?
Jeremy, is there anything more that you'd like to add on what Roger has just been telling us about?
No, I mean, I think the interesting thing that IPSX brings to the format is the fact that it is real-life data in a transaction. There isn't the lag that what one would get in a normal property sale, and I think it opens up opportunities to a more diverse investor pool.
Okay, yeah, I think we'd all agree with that.
Where the market is, it's very simple. As I tried to explain, that we're in the cycle, the trading cycle, and the investments just, in many cases, simply won't be available. We're in this part of the trading cycle where transactions, owners are reluctant to sell. And buyers, quite frankly, also are really not certain if they bought now whether they would see an asset that would decline further in value. So looking at the last two cycles over the last 35, 40 years would indicate that there's going to be a bit of a standoff, if that's the right word, over the next time series, which quite frankly no one can say. It could be a year, it could be 2 years. But what is clear is that when you're looking to investment to buy, the tenant has to be trading. Some very simple things. It's got to be trading. If it is trading, it's got to be paying the rent. If they're paying the rent, can they afford to pay the rent? And if they can't afford to pay the rent, might that rent go down in the future? So the transactions that are going through at prices which are broadly in line with what they were pre-COVID are the following types, which will come as no surprise, really. Supermarkets, local convenience stores, pharmacies, industrial units, anything on a long lease where the tenant is sound, such as a medical premises, job centres, and anything that actually particularly applies to London and the South East, where the commercial property has got proven alternative residential use. Now, the demand there remains high, but of course the vast majority of investments, retail investments historically, have not sort of fitted into that category. It's been primarily around the high street. And that's where the biggest issue is. At the end of the day, it's what the consumer wants to, what services the consumer wants to buy from their shops, their retailers, or what services they want to buy. And if they're not buying those services, then you must question whether the occupiers will be able to continue. I was going to say that that as we come out of the lockdown restrictions, and more shops open, you again will find that the buyers will come back looking at charity shops, restaurants and bars. But that's going to be a period of time, and it'll be really occupier by occupier led. But the buyers, the investors at the moment absolutely do want to buy. They're highly entrepreneurial. And they have a price for everything. The key thing is, though, and this goes back to previous cycles, is will the existing owners be prepared to sell at those prices? And the answer historically is no, until they're forced to do those.
Okay, thank you, Richard. We'll come back, I am sure, to a couple of those points if we get time. Meantime, there's been a few more questions that have come in. I'm going to come to, if I may, to Roger. There is a question here, Roger, about liquidity that IPSX provides. And the question is, do we have active traders in this stock exchange? Now, I guess what that question is really leading us towards is how does the market structure work? In other words, you were referring earlier to market makers. Might you just be able to answer that one for me?
Yeah, I think there are two important aspects to ensuring that there's liquidity in our market on IPSX. The first is the market making system, and I think everyone will be familiar with that. The idea is that the brokers or investment banks who commit to being market makers, to providing liquidity, they're required to quote firm two-way prices throughout the trading day, and we have the key providers of liquidity in London to small and mid-cap markets. We have Peel Hunt signed up and announced as a member of our exchange, along with Pamela Gordon, and we're shortly expecting Shore Capital and Winterflood to join that. So their system of making prices provides liquidity. The other really important factor, however, is for companies, and we're advising companies that we're talking to do this, to think carefully about how they construct or curate the register. If you list a company and you sell 20% of the shares to Blackrock and 15% of the shares to Schroeder's and 15% of the shares to Ameba, say, and those investors buy those shares for a 5% dividend yield from a good real estate asset managed well because they want the income, the chances are that you end up with a small group of investors who just sit and hold them, and then you don't see liquidity if liquidity is purely measured as the number of shares that trade on a daily basis. What we're going to ensure happens, as you do tend to see in some of the AIM-listed stocks rather than the main board of the LSE, is you see that on average AIM stocks have anything up to 50% of the ownership with retail investors who do tend to trade more actively and more often, admittedly in small lot sizes, but the fact is they're trading regularly and price discovery is happening regularly and liquidity is provided. We're going to do the same. We're going to make sure. We already have announced as trading and broking members on our exchange, the Share Centre, and we're shortly going to sign up 2 more of the largest retail platforms, and others will follow. This retail investor base will be a key part of providing liquidity.
Great. Thank you very much indeed, Roger, for answering so fully. Jeremy, let me come back to you. There's a very specific question here about the material uncertainty clause, and you referred to that in your piece earlier today. The question is, which markets or sectors have the material uncertainty clause been relaxed?
Yeah, I think I have actually answered that one, but to the person, but that's absolutely fine. In general, for the benefit of the audience, with the RSCS and with the agreement of all the major valuers, the material uncertainty clause was lifted, as I say, in certain sectors where we felt, or where the valuer feels, that the income is a minimum, I would say as a guidance, a minimum of 15 years income let to rock solid covenants. As I say, covenant is key. And this could be in distribution and or offices. And I believe I know it's been removed more recently where there are, again, standalone food stores let to good covenants on long unexpired terms, as well as a few others.
Yeah, thank you for that one. And my last question for you, Jeremy, and then we're going to start to move towards our close, as I'm conscious that we're now beginning to move towards the end. Question here for you again, Jeremy. Do you see caution / caveats in loan security valuation affecting transaction levels?
It's an interesting one because when the MUC was inserted into our valuation reports, there was a lot of dialogue with lenders. And at the end of the day, we explained why and the reasons why it was inserted into the valuation report. And as far as we understood and our reports were called on, the lending still went ahead with the MUC in. What we have heard, conversely, is that where, let's say, a certain fund has the MUC clause within their acquisition report, or proposed that it goes within their acquisition report, it's seen as a negative. So there has been, I suppose, a bit of push in those markets and those reports, so you can free up buying. So in a nutshell, it has worked against some buyers.
Okay, thank you. So with just a few more minutes to go before we finish, what I'd like to do, if I may, is bring back the first question that we started the session with, and just see whether or not anything has swung around in terms of the audience's thoughts around the question that we were asking. So let's get you that question up. Whilst we're doing that, panel, I'm going to put you, if I may, on notice. Once we've had the results back from our question, what I'd like to do is ask you for your closing thoughts, if I may. And in your closing thoughts and your closing remarks, you might just like to reflect back on this question in terms of your summary. And we're going to start our closing thoughts with Richard, then I will come to Jeremy, and lastly to Roger. So before we get to closing remarks, let's just go back to the question that we started this session with. Given what you have heard during the webinar, are you planning on investing now in commercial property in the next 3 months? So vote away. Give us your thoughts, give us your feedback, give us your views. If you think you are, please vote yes. If you think you're not, vote no. And of course, if you're quite not sure whether you're going to do that or do not, just vote undecided. So if you would like to vote away with that, we'll take your responses, and then I'm going to come to Richard, and then to Jeremy, and finally to Roger for last words. Right, I think that's given you plenty of time to get your decisions in. Let's see what the audience have to say. Right, interesting result. 43.2%, higher than average, I would suggest, are saying yes, they're going to look to buy. No, 29.7, 30%, okay. And we have almost another 1/3 there that are kind of, still reflecting and thinking about where they are. So very interesting results. Thank you very much indeed, audience. Really interesting to get your feedback on that point. Right, let's go now back to the panel to finish today's session. And Richard, if I may, it's your closing and final thoughts.
Thank you much indeed, Kevin. I would say that from a private investor perspective, there is still very, very strong interest to invest. I think that it's beholden upon the investor, the buying investor, to be even more forensic in the tenant's business. But certainly, if you've got the right tenant and the right business, and you've got the consumers buying the services or the products they offer, then absolutely continue investing in real estate. It's offering a significant margin over government gilts. As I said before, there are sectors of our market which have been very resilient during the crisis, and those are ones that are the most popular. The rest of them, the assets, I think you have to wait a little longer to see whether the rents are going to be paid or going to fall, and be more cautious about going forward. It's certainly not a one-way ticket at the moment that prices will continue to rise. We all know that. And therefore, we're not anywhere near that stage in the cycle that I spoke about before.
Okay, thank you very much indeed, Richard. Let's now turn to Jeremy, who I think it's fair to say has been a bit in the spotlight this afternoon. Jeremy, your thoughts?
Thank you, Kevin. I mean, it is an interesting time we find ourselves in, and just picking up on some of the points that Richard's also made. I mean, my personal view is I think sentiment is starting to improve. The fact that we're being eased out of lockdown, the fact that valuers are now able to inspect, agents are able to do the due diligence on sales and acquisitions. That is all very positive news. Stock availability will be an issue, as will debt in the market. So I think, as I said earlier, cash is God right now, and we know that there are a number of investors that are waiting to pounce in the market. I think some people feel that there is going to be distress in the market. I think that very well could be coming. I think the government measures have been holding it back, but my personal view, I think, there are some difficult times ahead, but obviously come tonight, Frank, and we'll be able to advise you. Thank you.
Excellent. Very good. Thank you very much. And lastly, Roger, please, over to you to close our session this afternoon.
Well, as you say, Kevin, very interesting to see the poll results. Of course, it's no surprise that more people are thinking about buying real estate. When you take a step back and you think about where does real estate fit in a multi-asset approach to life, and with an aging population globally that needs its investment portfolio to produce income, in a world where a quarter of the government bonds in issue globally are at zero or negative interest rates, and in a world where here in the UK, the FTSE 100 dividend payments this year will be probably no more than about a half of what they were last year in absolute monetary terms. Shell has cut its dividend for the first time in our lifetimes. Banks are legally not allowed to pay dividends. This is where people get their income from, or at least it was. So you've got to go and buy real estate. As both of my fellow panelists have said, which real estate you buy, making sure that it does pay rent and so pays a dividend or a coupon to you is important. So transparency is more important than ever, as is real-time pricing, because as we know, what real estate is really worth can be a bit of a a minefield for those who aren't in the know. So everybody needs more access to real estate. The asset class needs to be democratized. And I think COVID-19 and the lockdown may well catalyze that.
Great. Excellent, Roger. Thank you very much indeed for those closing thoughts. And for the audience that have joined us this afternoon, a very big thank you for your time. If you'd like to know more about IPSX, please do jump onto the website at ipsx.com. Plenty of webinars, podcasts, and so on for you to download, to listen to, and to watch. We'd be very, very happy to take any questions, as Knight Frank. Indeed, Jeremy would be as well, and I am sure Richard will be back in touch about his next auction. So it just leaves me to say I'm sorry to those that have been busy firing their questions in, that we just didn't quite get time to answer all of these. This has been such a popular event today that I will be talking to colleagues again at Acuitus and Knight Frank to see whether we might want to do some sort of rerun. All it leaves me to say is a very, very good afternoon to you all. Thank you so much for joining us, and a very warm goodbye.